Hey everyone, welcome back to Corporate Decoder. Today GTI just filed an 8K and I'm seeing some seriously interesting moves with A.U.R.I Incorporated. Quick note, this is not financial advice, just my take on public filings for educational purposes. It looks like there is a significant debt exchange happening and some very public back and forth about that debt. Alright, so what we have here is a filing from Global Tech Industries Group Incorporated. They are a company that has been in receivership, meaning a court has appointed someone to manage their assets because they are in some sort of financial trouble. In this case, the court appointed a receiver named Paul Strickland. The main event here is an agreement signed on the 7th of April 2026. The G.T.I.I Receivership Estate, which is basically the pool of assets being managed by the receiver, bought some debt. They bought two convertible promissory notes from a company called MSC Capital Advisors LLC. These notes are owed by another company called A.U.R.I Incorporated. Think of it like the Receivership Estate buying IS from A.U.R.I that MSC Capital Advisors LLC used to own. Let's break down those notes. The first one was originally for $100,000, issued back in October 2024. It was supposed to mature in October 2025 and carried an 8% interest rate, but a much higher 22% if it went into default. And guess what? It is in default. By the time it was bought, about $10,356 in interest had piled up. The second note was smaller, $25,000, issued in March 2025 with the same interest rates and a maturity in March 2026. This one is also in default with about $1,995 in accrued interest by the assignment date. So in total, the Receivership Estate is taking on $125,000 in principal for these two notes. MSC Capital Advisors LLC originally bought these notes for a much lower price, $35,000 for the first one and $10,000 for the second. That means they bought them for a total of $45,000 and are now selling them, in a way for the $125,000 value, plus a profit share. Now, why did MSC sell these notes to the Receivership Estate? It turns out MSC owed money to the Receivership Estate itself under a separate $100,000 note that MSC had also defaulted on. So this whole deal is essentially MSC paying off its debt to the Receivership Estate by handing over these A.U.R.I notes. MSC also gets to keep some of the upside, up to $100,000, if the Receivership Estate successfully recovers money from these A.U.R.I notes. Here is where it gets really interesting. These notes are convertible. That means the holder, in this case the receiver, can choose to convert the debt into shares of A.U.R.I common stock, and the conversion price is a steal. It's set at 25% of the market price of A.U.R.I stock. This is like saying for every dollar of debt, you can get stock that's worth $4 at market price. That is a 75% discount, and it seems the receiver acted fast. On the 7th of April and the 8th of April 2026, they sent notices to A.U.R.I to convert part of the first note. They asked for a huge chunk of A.U.R.I. Stock 841 million shares, which is apparently all the authorized but unissued stock A.U.R.I had. They did this at a conversion price of $0.00005 per S-share, which was indeed 25% of the market price at the time. This conversion was applied first to cover the interest owed and then to the principal. After the first conversion, the remaining principal on that first note is down to about $76,305. And for the second note, the total remaining balance, including principal and interest, is about $27,211. So, the total debt still owed on these A.U.R.I notes is around $103,516. A really significant point here is that after this conversion request, A.U.R.I has no more authorized but unissued shares of common stock left. To issue any more, they would need to authorize a massive amount of new shares, something like $9.3 billion to maintain a required share reserve. Now, this is where the public drama really starts. On the 17th of April 2026, the receiver sent a letter to OTC Markets Group, the organization that manages trading for many over-the-counter stocks. The receiver pointed out that A.U.R.I had failed to disclose these two convertible notes in its recent financial filings. This is a big deal because companies trading on regulated markets are required to disclose material debts and agreements. The receiver reminded OTC Markets that the outstanding balance on these notes was still over $103,000. They essentially asked OTC Markets to pressure A.U.R.I into disclosing this information properly in all future filings, including details like the note dates, amounts, maturity dates, and conversion terms. The receiver even warned that if A.U.R.I didn't fix this disclosure problem, it could impact its trading tier status on OTC markets. And then things escalated. Just a couple of days before the receiver notified OTC Markets, on the 15th of April 2026, A.U.R.I itself put out a press release. In this press release, they claimed they had no convertible notes outstanding and does not intend to take on any toxic financing. This statement, directly from A.U.R.I, was flat out false and misleading. The filing points out that at the exact time AURI made this statement, the GTI Receivership Estate held these two convertible notes with a balance of over $103,000, and conversion notices had already been sent. The filing even provides a link to that press release, showing that AURI was not only not disclosing the debt but actively denying its existence. The receiver has made sure OTC Markets Group is aware of this discrepancy. When a company makes false statements about its financial obligations, especially in a public press release, it can have serious consequences. It erodes trust with investors and regulators. So what is the takeaway here? We have a company in receivership, the GTI Receivership Estate, actively managing its assets by acquiring and then converting debt into equity. They are essentially turning debt owed to them into ownership of another company, A.U.R.I Incorporated. The story then becomes a public dispute. A.U.R.I apparently didn't want to disclose its debt and even publicly denied having any, while the receiver is pushing for transparency and holding them accountable. This situation highlights the complexities of distressed companies and their assets. The receiver is using a strategy to maximize recovery, which involves converting debt into equity in A.U.R.I. The fact that A.U.R.I has run out of authorized shares after this conversion suggests their capitalization structure is very tight. Looking at the dates, the assignment happened on the 7th of April. Conversions were sent the 7th of April and 8th. A.U.R.I issued its potentially misleading press release on the 15th of April, and the receiver notified OTC markets on the 17th of April. This is a pretty rapid sequence of events. The risk I am watching is how A.U.R.I will respond to the need to authorize billions more shares. My biggest concern is how A.U.R.I's deliberate misrepresentation of its financial situation will be handled by OTC markets. What I am actually looking for is the next filing from A.U.R.I to see if they correct the record. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.